The money is already being moved right now. As you watch this video, as you scroll on your phone, as you hesitate between clicking away or staying with me, the largest transfer of wealth in human history is actively taking place, and 99% of people have no idea where that money is actually flowing. Today is Saturday, January 18th, 2026, and I'm going to show you clear proof that $45 trillion is in the process of shifting from one generation to the next, from baby boomers to Gen X and millennials. The individuals who understand where this capital needs to be positioned will build true generational wealth. Everyone else will watch their inheritance slowly disappear through inflation, taxes, and the deliberate erosion of paper-based financial assets. This has nothing to do with stocks. This has nothing to do with real estate. And this is not about cryptocurrency either. This is about the oldest method of preserving wealth humanity has ever known. And once you learn how to read the data correctly, the evidence that this shift is accelerating is impossible to ignore. I'm going to walk you through what's happening, why the next 24 months are critical, and how they will decide whether you capture this wealth or lose it entirely. And I'll explain why silver at $89.22 per ounce as of yesterday morning isn't the top. It's the floor of the largest repricing event we will see in our lifetimes. Let's begin with the raw numbers because they're so massive that they're hard to fully grasp. According to the latest data from Cerulli Associates, published in December 2025, roughly $124 trillion is expected to transfer from baby boomers and the silent generation to younger generations by the year 2048. Read that again. $124 trillion. That figure alone exceeds 5 times the current GDP of the United States. More wealth will change hands over the next 22 years than was accumulated across the entire previous century. But here's why this matters right now. Today, in January of 2026. This transfer isn't spread evenly across those 22 years. It's heavily front-loaded. Based on data from Macromonitor, the largest survey of U.S. financial behavior, households with individuals aged 70 and older are expected to transfer $45 trillion to the next generation over the next 10 years. Not over 22 years, over just a decade. That works out to an average of $4.5 trillion every year, about $375 billion each month, roughly $12.3 billion every single day. Now here's the part that should deeply concern anyone expecting to inherit this money. That $45 trillion figure is calculated in today's dollars, assuming purchasing power stays stable. But the dollar is anything but stable. The dollar is failing. And if you inherit a portion of that $45 trillion and leave it sitting in dollars, bonds, or traditional financial instruments, you will watch its real value shrink in front of you. Let me explain exactly why. The U.S. national debt crossed $38 trillion on January 1st, 2026, just 18 days ago. The annual interest on that debt is now $1.21 trillion, which is more than the country spends on national defense. The government is now borrowing money simply to cover the interest on debt it already took on. That is the textbook definition of a debt spiral. And historically, there are only 2 ways out of a debt spiral. One is default, which destroys a currency overnight. The other is inflation, which destroys it gradually. Governments always choose inflation, every time. They print money. They weaken the currency. They quietly reduce the purchasing power of your inheritance until that $45 trillion buys only a fraction of what it once could. This isn't theory. This isn't speculation. This is happening right now. Between December 26th and December 28th, 2025, the Federal Reserve injected $51 billion into the banking system through emergency repo operations. That's $51 billion printed in just 72 hours to stop banks from collapsing due to their silver short positions when silver surged to $84. Every time the Federal Reserve creates money to rescue the financial system, the value of every existing dollar is diluted. And if they can print $51 billion in 3 days, ask yourself how much they'll print over the next 10 years as they attempt to manage a $38 trillion debt load. The answer is trillions. And every new trillion printed further erodes the value of your inheritance. Now let me show you where the smart money is going, because this $45 trillion transfer is not being parked in dollars. The people receiving this wealth, Gen X investors set to inherit $1.4 trillion per year over the next decade, and millennials projected to receive $45.6 trillion over the next 25 years, are making very different choices. They aren't leaving their money in savings accounts paying 5%, while inflation runs at 8 to 12%. They are reallocating it into hard assets. Real estate, gold, silver, land, commodities, assets that can't be printed, assets that hold purchasing power when currencies fail. And the proof of this shift is already visible in how those assets are being priced. Real estate prices among high net worth households have risen 29.4% since 2020, according to Coldwell Banker Global Luxury's 2026 Trend Report released on January 16th, just 2 days ago. Gold reached a new all-time high of $4,747 per ounce on January 13th, gaining roughly 65% in 2025 alone. And silver, the most undervalued hard asset on Earth, surged 150% in 2025, climbing from $30 per ounce in January 2025 to $91.78 on January 14th, 2026, and is now trading at $89.22 as of Friday, January 17th. This isn't a speculative bubble. This is a repricing. This is the market finally acknowledging that paper assets are losing relevance and that hard assets are the only reliable stores of value during currency debasement. But here's where things become especially compelling. While gold and real estate are already moving higher, silver offers the largest upside with the lowest capital requirement. Let me break down the math. If you're a millennial or a Gen X investor inheriting a slice of that $45 trillion slice, 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 of that $45 trillion slice. But according to Coldwell Banker, The average luxury home in the United States now costs more than $2 million. That's a steep entry point. You could buy gold. Gold is currently priced at $4,747 per ounce. With a $50,000 inheritance, that gets you roughly 10.7 ounces of gold. But silver tells a very different story. At $89.22 per ounce, that same $50,000 buys about 560 ounces of silver. And that difference matters a lot. The gold to silver ratio, which compares the price of gold to the price of silver, is currently around 52 to 1. In other words, it takes 52 ounces of silver to equal the value of 1 ounce of gold. Historically, over the past 2,000 years, that ratio has averaged between 10 to 1 and 15 to 1. Even in more recent history, during the 1980 precious metals rally, the ratio compressed to 17 to 1. In the 2011 rally, it reached 31 to 1. At today's level of 52 to 1, silver remains historically cheap relative to gold. If the ratio merely returns to 30 to 1, a conservative assumption by historical standards, silver would need to rise to $154.90 per ounce just to align with gold's current price. That represents a 73% increase from today's levels. If the ratio tightens to 20 to 1, silver reaches $232.35 per ounce, a 160% gain. And if it fully reverts to the long-term historical average of 15 to 1, silver would trade at $309.80 per ounce, a 247% increase. Now, some of you might be asking why this ratio would revert at all. Why should silver catch up to gold? The answer comes down to supply and demand. Gold functions primarily as a monetary metal. Central banks accumulate it. Investors store it. Roughly 90% of all the gold ever mined still exists today because gold isn't consumed. It's reused and recycled. Silver operates very differently. Silver is an industrial metal. About 65% of annual silver production is used in industrial applications that permanently consume it. Solar panels, electronics, medical equipment, batteries, water purification systems. Once silver is used in these applications, it's effectively gone. Recovering it isn't economically viable, and industrial demand is accelerating rapidly. According to the Silver Institute, the solar sector alone consumed roughly 200 million ounces of silver in 2024. By 2026, demand is expected to rise to 287 million ounces, a 43.5% increase. Electric vehicles, AI data centers, and 5G infrastructure all require substantial amounts of silver. And here's the bottleneck. Global silver mine production totals only about 800 million ounces per year. Of that, roughly 520 million ounces are immediately absorbed by industrial use. That leaves just 280 million ounces available for investment demand, ETF accumulation, and physical vault storage. Yet combined investment demand and industrial stockpiling are running between 400 and 450 million ounces annually. That creates a structural shortfall of 120 to 170 million ounces every single year. This imbalance has persisted for 5 straight years. The cumulative deficit now stands near 800 million ounces. That's the equivalent of an entire year of global silver production that has been consumed without replacement. And supply can't quickly respond. Nearly 70% of silver is produced as a byproduct of mining copper, zinc, and lead. Even if silver prices double, that alone doesn't result in new silver mines. For primary silver mines, the timeline from discovery to production is typically 8 to 12 years. The shortage isn't coming. It's already here. Supply cannot adjust in time. And as the $45 trillion wealth transfer accelerates, as Gen X and millennial investors shift inherited capital into hard assets, physical silver demand will overwhelm what little supply remains. And we already have proof this is happening. On January 13, 2026, just 5 days ago, the United States Mint suspended sales of all silver products for the first time in modern history. They cited unprecedented demand and supply chain limitations. But the U.S. Mint holds priority purchasing authority as a government institution. If even they can't source enough silver to mint coins, that tells you everything you need to know. It tells you the supply is already gone. On January 7, 2026, J.P. Morgan took delivery of 8.1 million ounces of silver on the COMEX, accounting for 99% of all silver delivered for the entire month of January. A single bank absorbed virtually the whole month's supply. That is not normal behavior. This is panic buying. This is institutional money that understands the shortage is real and is securing physical metal while it's still available. And the pressure is showing up clearly in physical premiums. In Tokyo, physical silver bars are selling for around $130 per ounce, while the paper spot price sits near $89. That's a $41 premium, a 46% markup over paper pricing. In Dubai, premiums range from $25 to $35 above spot. In India, dealers are quoting $110 to $115 per ounce for guaranteed delivery. Globally, the average premium for physical silver is now roughly $20 to $25 above the paper price. That means the real clearing price of silver, the price at which actual metal changes hands for delivery, isn't $89. It's closer to $109 to $114. The $89 paper price is an illusion, upheld by a derivatives market that simply doesn't have enough metal to honor its obligations. And this is where the $45 trillion wealth transfer collides directly with the silver shortage. Because the people inheriting this wealth, Gen X and millennials set to receive trillions, are not baby boomers. They don't trust traditional financial institutions. They don't view the stock market the way their parents did. They lived through the 2008 financial crisis. They watched the massive money printing during 2020. They saw their parents' 401s get cut in half, not once but twice, and as a result, they are choosing different assets. According to the UBS Global Wealth Report 2025, women are expected to control roughly $40 trillion of this wealth transfer, either through direct inheritance or through widowhood. And women invest differently than men. They tend to be more risk-conscious. They favor tangible, real assets. They hold more deposits and allocate more capital to physical gold and silver. As wealth increasingly shifts into female hands, demand for physical precious metals rises. At the same time, data from Jupiter Asset Management shows that millennials and Gen Z clients at high net worth focused firms increased from just 8% in 2021 to 25% by 2024. That's more than a threefold increase in just 3 years. These younger investors are far more open to alternative assets, precious metals, private equity, and direct ownership. They aren't buying bonds yielding 4%. They're buying assets that cannot be diluted. And silver, with its low entry price and enormous upside potential, fits this demographic shift perfectly. Now let's talk about timing, because the $45 trillion transfer doesn't happen evenly over 10 years. It accelerates. According to Cerulli, Gen X alone is set to receive nearly $1.4 trillion per year over the next decade. That's about $116 billion every month. But these transfers aren't smooth or linear. They surge around major life events: deaths, retirements, and estate settlements. Demographic data shows that the peak years for baby boomer deaths fall between 2026 and 2030. The oldest boomers, born in 1946, turn 80 in 2026. Average life expectancy sits between 78 and 80 years. We are entering the peak inheritance window right now. And here's what that means. If just 5% of the $1.4 trillion flowing annually to Gen X is allocated to silver, that equals $70 billion in yearly silver demand. At current prices of $89 per ounce, that translates to roughly 785 million ounces of silver per year from Gen X alone. Total global mine production is about 800 million ounces annually. That means Gen X, allocating just 5% of inherited wealth to silver, would consume nearly the entire world's yearly supply. And that's before adding millennial demand, before accounting for industrial use, and before factoring in global investor demand. The numbers don't add up. There simply isn't enough silver to meet the demand that's forming. And this leads to the most critical point of this entire video. The $45 trillion wealth transfer isn't a future event. It's happening right now. Today, January 18th, 2026, somewhere in the United States, a Gen X or millennial just inherited $500,000 from a parent who passed away. And they face a decision: Leave it in a savings account earning 5% while inflation runs between 8 and 12%, losing purchasing power every single month. Put it into the stock market at all-time highs, hoping valuations rise further despite every historical warning sign flashing bubble. Buy bonds yielding 4%, locking in a guaranteed real loss after inflation. Or move into hard assets, real estate, gold, silver, assets that have preserved value for thousands of years, assets that can't be printed, assets that rise when currencies fail. And for someone inheriting $500,000, silver offers the most compelling risk-to-reward profile of any hard asset. Buying real estate requires a 20% down payment, ongoing mortgage obligations, property taxes, and constant maintenance. Buying gold at $4,647 per ounce yields just 107 ounces. But buying silver at $89 per ounce delivers 5,617 ounces. And when silver reaches $200, a level that every major fundamental indicator suggests is actually conservative, those 5,617 ounces become worth $1.123 million. A $500,000 inheritance turns into more than $1.1 million. A 124% gain simply by holding physical metal through a repricing event that is already in motion. But this is where most people fall into the trap. The trap is believing you still have time. The trap is thinking silver at $89 is expensive. The trap is waiting for a pullback to $70 or $75 that is never coming. Because the entities moving this $45 trillion, the financial advisors overseeing the transfer, the family offices managing multi-generational estates, they are not waiting. They are buying now. And the proof is sitting in the vault data. As of January 14th, 2026, COMEX registered silver inventory stood at just 127 million ounces. In 2020, that number was over 400 million ounces. That means inventories have fallen by 68% in just 5 years, and the pace of that decline is accelerating. Between January 1st and January 14th, 2026, COMEX inventories dropped by roughly 11 million ounces, about 785,000 ounces per day. At that rate, the vaults are effectively empty by May 2026. Then comes February 20th, 2026, first notice day for the March contract. If delivery requests exceed available inventory, COMEX will be forced into a corner. They either implement emergency measures, raise margins, restrict positions, offer cash settlements, or declare force majeure and admit they cannot deliver physical metal. Any of those outcomes destroys confidence in the paper market. And once confidence in paper silver collapses, physical silver resets to its real price, which based on current premiums is already between $109 and $114, and could easily surge to $150, $200, or higher as buyers compete for what little supply remains. Now let me address the counter-argument. Some analysts claim silver at $89 is overvalued. Citigroup projects silver averaging $70 in 2026 and argues anything above that is fundamentally stretched. HSBC raised its forecast to $68.25, while still warning of downside risk. These are the same banks that predicted an average silver price of $32 for 2025. The year silver surged 146% from $28 to a peak of $92.25 on January 14th. 2026. They were wrong by a factor of 3. They missed the entire move. And now they're telling you to sell at $89. Why? Because these banks are short silver. They need you to believe the rally is finished. They need you to sell. Because if enough people demand delivery at the same time, the banks become insolvent. Do not listen to them. Look at the fundamentals. China imposed silver export restrictions on January 1st, 2026. Cutting Western access by 85%. The U.S. Mint suspended silver sales on January 13. COMEX vaults are draining at nearly 785,000 ounces per day. Physical premiums sit $20 to $40 above spot. Industrial demand is growing at 15 to 20% per year. And the $45 trillion wealth transfer is only beginning. Every single one of these factors points to higher prices, not lower. But here's where urgency matters. Because while silver is cheap relative to where it's going, it no longer feels cheap in absolute terms. At $89 per ounce, many retail investors feel priced out. They remember silver at $20 or $30, and by comparison, $89 feels expensive. That mindset is backwards. Silver isn't expensive because it rose from $30 to $89. Silver is cheap because it's moving from $89 to $200 or higher. What you pay today doesn't matter. The only price that matters is the one you sell at in the future. If you buy at $89 and sell at $200, you more than double your money. If you wait for $70 and it never comes, you own 0 ounces and miss the entire move. The $45 trillion wealth transfer does not wait for you to feel comfortable. It does not pause until you feel ready. It is happening right now. And the people who position early, who buy physical silver at $89, $95, or even $100, are the ones who capture generational wealth. The people who hesitate, who try to perfectly time the bottom, who trust banks telling them silver is overvalued, those people will stand on the sidelines, watching their inheritance lose purchasing power, wondering why they didn't act when they had the opportunity. Let me show you one final critical data point. According to Coldwell Banker's Global Luxury 2026 Trend Report, published on January 16, 2026, nearly $2.4 trillion in U.S. real estate will change hands over the next decade as part of the wealth transfer, accounting for 52% of all global luxury property transactions. Gen X is the primary near-term recipient, while millennials receive the largest share over the long run. Since 2020, global wealth among high-net-worth individuals has increased by nearly 40%, including a 29.4% rise in real estate holdings. Real estate has acted as a counter-cyclical asset, but here's the problem with real estate for the average person inheriting wealth. Real estate is not liquid. You cannot sell a house in 24 hours. You cannot break a house into small, divisible pieces. You cannot easily store a house, but silver is liquid. You can sell a single ounce in minutes. You can buy a little or a lot. You can store it, transport it, and divide it effortlessly. And most importantly, silver offers dramatically greater upside than real estate over the next 5 years. Real estate has already risen 29.4% since 2020. That's a solid return. But silver gained 150% in 2025 alone. And silver is only at the beginning of its move. While real estate is stabilizing and likely to grow at 5% to 10% per year, silver is entering a severe supply-demand imbalance that could push prices up 100% to 200% or more within the next 24 months. If you are inheriting wealth, if you are receiving a portion of that $45 trillion, allocating a meaningful share to physical silver makes sense. Not all of it. Diversify. Own real estate. Own gold. Own land. But do not ignore the asset with the strongest risk-reward profile, the lowest capital barrier, and the greatest upside in a world where currencies are being systematically destroyed. And here is the final warning. Because the window to buy physical silver is closing. Not symbolically, literally. The U.S. Mint suspended sales on January 13th. Other mints will follow. The Royal Canadian Mint, the Perth Mint, the Austrian Mint. One by one, they will halt production as they run out of blank planchets and lose access to refined silver. Dealers are already quoting delivery delays of 4 to 8 weeks. In 2 months, those delays could stretch to 12 or 16 weeks. In 6 months, dealers may stop taking orders entirely because inventory simply cannot be sourced. The buy button is disappearing. Once it's gone, once mints are shut down, once dealers are sold out, once COMEX declares force majeure and admits it cannot deliver, the only way to acquire silver will be from private holders at whatever price they demand. And those holders, the ones who bought at $50, $60, $70, $89, will not sell at $100. They will wait for $150, $200, $250, because they will understand the paper just failed, and metal is the only asset left standing. And by then, the $45 trillion wealth transfer will be complete. Those who moved their inheritance into hard assets early will have protected and multiplied their wealth. Those who left it in dollars, bonds, and stocks will have watched it erode through inflation and market collapses. And those who waited, who believed they had time, who trusted analysts claiming silver was overvalued, will be locked out completely, unable to buy at any price. Today is January 18th, 2026. The $45 trillion wealth transfer is not approaching. It is here. It is happening right now. And the question isn't whether you'll be affected. The question is whether you position yourself to win or to lose. Silver at $89.22 is not expensive. It is a gift. It is the final opportunity to acquire physical metal before supply vanishes, before mints shut down, before COMEX defaults, before the paper market collapses. The wealthy are already moving their money. Smart capital is flowing into hard assets, and the largest wealth transfer in human history is rewarding those who understand one simple truth. Currencies fail, governments deceive, and metal survives. Act now. Buy physical silver, hold it, and prepare for the moment when $45 trillion finishes moving between generations and discovers that the only assets that matter are the ones that cannot be printed. This is not financial advice. This is observable reality. The data is clear, the transfer is real, the shortage is real. And the repricing that takes silver from $89 to $200 or beyond is not speculation. It is mathematical inevitability driven by constrained supply, exploding industrial demand, and the largest intergenerational wealth shift humanity has ever seen. You have weeks, possibly days, before the window closes. Choose wisely. If you want more videos breaking down stories like this, make sure to like and subscribe. Thanks for watching.